Hey there, YouTube. It's Matt Decker with Leveraged Wealth Management and Cash Value Life Insurance Reviews. I get a ton of questions from my business owner clients about SEP IRAs and what other alternatives out there exist in the marketplace. And so we are going to tackle that topic today, SEP IRA alternatives. Before we get into the alternatives, you first need to understand a few things about SEP IRAs. Number one, a SEP IRA is going to provide business owners with tax-deductible contributions, and that money will not be taxed until the business owner withdraws the funds. So these plans are taxed at withdrawal time. The other thing I want you to know about these plans is that they actually allow for relatively high contribution amounts. So unlike an IRA outside of work or a 401k, business owners can put in up to $55,000 per year into these SEP IRA plans. So the limits are relatively high, which is a beautiful thing. The last thing that I want to point out about SEP IRAs is that if you make a contribution for yourself, you must include all employees. So whatever you do for yourself as the business owner, you must also do for your employees, meaning that there is no discrimination in these plans. Now, that's not an exhaustive list on the SEP IRA. It is just a generic overview. It functions mostly like a traditional IRA, the main difference being higher contribution limits. And as an employer, if you contribute for one person, you have to contribute for everybody. This no discrimination provision is exactly why successful business owners looking for relatively high limits of deferral are actually looking at alternatives to the SEP IRA, because it can get expensive to do this SEP IRA plan if you have employees. So if you followed this channel at all for any length of time, you actually know that I'm a huge proponent of cash value life insurance. So what I'd like to do is show you an alternative using cash value life insurance in place of a SEP IRA. And there's a few reasons that I'm going to show you life insurance in place of a SEP IRA. But before we get into the reasons why, I just want to show you a generic index universal life insurance policy designed the right way for maximum tax-free retirement income. So this is one of my favorite policies. It's a policy from North American. It's for a 50-year-old male, standard non-tobacco, and you'll notice we're paying $38,500 a year. Now, the reason that we're paying $38,500 a year is because this individual has an effective tax rate of 30%, and so if we were to put in $55,000 into a SEP IRA, that $55,000 would turn into $38,500 because this is an after-tax plan. So we have to pay taxes on the money before it goes into the policy. So we're netting the taxes out of this contribution to make it comparable to the SEP IRA. So we're paying $38,000 a year for the first 15 years of this contract. And then what we're going to do is we're going to turn this contract into a lifetime stream of income. And our lifetime stream of income, tax-free, is going to be $88,000 per year for life, assuming a 6.64% rate of return. So the couple things that you need to key in on here for when we compare this to the SEP IRA is we're getting out $88,000 a year. Again, that's tax-free. And we're using a 6.64% rate of return, and this policy has no market risk. So we're not going to fluctuate with the market up and down. Now, that's not to say that it's a fixed 6.64% every single year, but on average, we're assuming that we're going to get 6.64%. If Index Universal Life Insurance is new to you, then I'd encourage you to check out the videos that I've linked above that go into how these policies work and how they should be structured. So absolutely check that out first if you're not familiar with these policies. But what I'd like to do now is I want to compare this to an actual SEP IRA illustration or a SEP IRA hypothetical sample. So this is our Sep Ira sample right here, column 1. You'll notice that all we did is we took the tax rate, the effective tax rate that this person is in. We're taking our $38,500 after-tax contribution, and we're making it $55,000 pre-tax. So these numbers are equivalent. We're comparing $55,000 pre-tax into the SEP, up against $38,500 a year in the Index Universal Life Insurance contract. And you'll also notice that while we're contributing to this plan, I'm assuming a levelized 10% rate of return every single year in our Sep IRA, which you and I both know is not going to happen, but we're assuming 10% every single year in our Sep IRA with no market losses, and then we're reducing that to 5% once we start taking out income. Now, why do we reduce it to 5%? Because once you start taking money out of any contract, you should adjust your risk return profile. You should take less risk to make sure that you avoid market losses. And this is relatively standard. And so what we're trying to do is we're trying to get the same $88,000 a year after tax from our Sep IRA in order to mirror the income that the Index Universal Life Insurance policy was generating tax-free. So here's what this actually looks like side by side. On the right-hand side, we have our Index Universal Life Insurance policy values with our death benefit, our surrender value, and our net after-tax income. This is tax-free income. And then we're comparing that to our SEP, which is these three columns here on the left. And we're, again, assuming $55,000 a year pre-tax into the SEP and $88,000 a year net after tax in income. And what you'll notice is that if we try to mirror the exact same income using the Sep IRA that the Indexed Universal Life Insurance policy can generate, we actually run out of money at age 90. Now, I'm sure that some of you are probably wondering, yes, but what about the fees? What are you using for fees? Well, it just so happens that one of the best outlets for a Sep IRA is a company that you all know about. You've all heard of them. They are called Vanguard. They have some of the absolute cheapest options for a Sep IRA, and I've used their fees, their average fund fees, in order to calculate all of these numbers. And the average fund fees for a Sep IRA with Vanguard are 0.12% management fee. So nearly 0.1% per year in fees. That's all I'm showing on the Sep IRA side of things. So next to nothing in fees. And yes, the life insurance, this is all net of life insurance fees. All of the fees associated with life insurance are factored into all of these columns and this income. So we have two accounts side by side, a Sep IRA showing 12 basis points in fees. That's basically 0.1% in fees per year versus an Index Universal Life Insurance policy that's structured the right way, netting out all of the fees that are associated with life insurance. And we're able to take that $88,000 a year all the way to age 100. We run out of money in the Sep IRA at age 90, and all of our Index Universal Life Insurance policies are not subject to market risk. Our Sep IRA is absolutely subject to market risk, and yet we're assuming zero losses in the Sep IRA in all years, which you and I both know is not going to happen. There are going to be years where you experience a loss. We're not showing any of that. We're showing a levelized rate of return in the Sep IRA. So aside from seemingly being able to generate a higher income tax-free without market risk using an Index Universal Life Insurance policy versus a Sep IRA, why else would someone opt for an Index Universal Life Insurance policy over and above a Sep IRA? Well, there's a bunch of reasons. Let's go ahead and list out the reasons. So in the Sep IRA, you can contribute up to $55,000 per year. It's tax deductible. It's taxed on the way out. You are subject to market risk. You do have low fees if you go with a company like a Vanguard. 12 basis points is nothing. You can't touch your money until 59.5 without paying penalties. But the big negative here with the Sep IRA is that there is no discrimination, meaning if you want to contribute 20% of your income to a Sep IRA, if you have employees, you have to contribute 20% of your employees' income to their own Sep IRAs. So with employees, this gets extremely expensive very quickly. Over on our Indexed UL side, there's really no limit on what we can contribute. in any given year. It's after tax. It's not tax deductible, but the money does grow tax-free, and it comes out tax-free. We certainly have higher fees than 12 basis points. There's no 59.5 rule. But really, the kicker here is that you absolutely can discriminate. If you only want to contribute towards one of these policies for yourself as the business owner, and you do not want to incorporate other employees into the plan because it gets too expensive too quickly, you're absolutely allowed to do that because this is an after-tax plan. It's not subject to any ERISA reporting requirements, and so you can pretty much pay what you want, when you want, and you can choose who gets to participate. And on top of all that, it appears that in most cases, your index universal life insurance policy is actually going to generate more income, assuming moderate growth. Now, if you're able to sustain 10 to 15% annualized returns every single year for the next 40 or 50 years, then of course the Sep IRA is going to generate more income. Of course it is. But that's not a reality. And when business owners look at the index universal life insurance policy through a risk-adjusted returns lens, it becomes an extremely attractive option. If you want to look at an index universal life insurance policy in place of something like a Sep IRA, I'd love to help you with that. You need to go to leveragedwm.com/IUL-review. That's IUL-review. I'll put a link in the description below, as well as pin a comment with the link. You can go there, you can fill out the form, I'll be in contact with you, and we can look at getting a policy that's structured the right way, that's going to do exactly what you want. I hope this has been helpful. This is Matt Decker with Cash Value Life Insurance Reviews on YouTube and Leverage Wealth Management. We'll talk to you next time.